The AI mania that has been fueling tech stocks is showing serious cracks, and Oracle might be one of the first high-profile casualties. What looked like a high-flyer ride into the future is starting to look like another hype play with little backing. Oracle recently reported that its AI infrastructure business renting servers powered by Nvidia chips brought in about $900 million in revenue in the latest quarter. But here is where it gets ugly. The gross profit margin on that was only around 14%. That's a far cry from the 70% plus margins in its legacy software and cloud segments. In other words, Oracle is leasing out expensive hardware and facilities, but what it's making after costs is barely scraping the bottom line. The high operating capex, data center buildouts, and maintenance burdens are eating into the upside. Investors are waking up to the reality that not all cloud plus AI bets pay off. Because Oracle's stock had ridden the AI wave so aggressively driven by expectations, big contracts, and momentum, the drop now is starker. The share price slid sharply when markets began to question whether this revenue is sustainable or margin-destroying. This scenario underscores a broader warning. Many AI plays are valued on promises, not profits. When hype outpaces economics, the fallout can be brutal. If you enjoyed this insight, like the video, subscribe to the channel for more no BS market breakdowns, and hit the so you don't miss my next take on which AI stocks could collapse next.